What is a dividend stock? Well, according to Investopedia, dividend stocks are stocks of companies that pay shareholders a percentage of their earnings regularly. In essence, these companies reward you for being an investor in their company. These dividends can be paid monthly, quarterly, semi-annually, and annually. I currently own a ton of dividend stocks, and we'll go over my absolute favorite dividend stock right now at the end of this video. Not all stocks pay a dividend though, and in order to find out if they do, you can head over to Yahoo Finance and look in the yield section. If the company has a yield, then they pay a dividend, but it's not that simple. In order for it to be considered a great investment, we need to see that the company has a stack of cash on hand. We want to see that if the economy was to completely crash and people stop buying their products or services, would they be able to continue paying us? If so, for how long? By the end of this video, you'll be able to figure that out. So circling back to our yield, the yield is the amount in the form of a percentage of the share price that is returned to us for investing in the company over a 12-month period. For example, if Apple stock is trading at $100 and we were paying a 5% yield, we would at the end of the year have an extra $5 of cash from Apple. We can think of dividend investing as investing in an income stream. The stability of this income stream is super important because sometimes new investors get distracted by shiny high yields and don't realize the sustainability of that yield matters more than the payout amount. After all, who would buy an income stream that will disappear after a month? The best indicator in my opinion for dividend safety is the payout ratio. The payout ratio shows how much earnings are retained after the dividend is paid. The formula for this is dividend payout ratio equals dividends divided by net income. I like to look for companies who retain more than 50% of their earnings, but the company's maturity and stability can vary for what percent is acceptable. For example, a stable company who's older and the business is growing slow and has a really solid business model is generating roughly the same amount of revenue quarter over quarter and can afford a higher payout ratio because the business is consistent. Another thing to consider when picking a dividend stock is its past performance. During recessionary periods like 2008, COVID, and even these current market conditions, was the company able to sustain the same dividend without missing a quarter or cutting it? For example, over the last 60 years, Johnson & Johnson has paid their dividends without missing. They also increased their yield by over 10% over that period. This would make Johnson & Johnson a great company to invest in for dividends. This is why dividends are beautiful, because not only has Johnson & Johnson paid dividends consistently for the last 60 years, the share price has also grown substantially. This gives you two different possible income streams within the stock: capital gains from the shares and dividends paid. Again, let's try not to get sucked in by a high yield, because if things sound too good to be true, they typically are. When yields become high, it's typically because the share price dropped in recent trading. This can mean that investors are expecting bad earnings or an unsustainable dividend. This most of the time leads to a cut in the dividend and a subsequent further drop in share price. In order to find out how long a company can continue to pay us, there's a little bit of math involved. Say Apple stock is trading at $100 with a 5% dividend yield. We can find out how much money per share Apple is paying by taking 5% of $100, which leaves us with $5. We then need to find Apple's number of outstanding shares, which can be found by dividing the company's market cap by share price. If Apple is trading at $100 and the market cap is $1 million, after division, we find that Apple has 10,000 shares outstanding. So the last step is to multiply $5 by 10,000, which equals 50,000. This means Apple is losing $50,000 a year of potential money they could be using to invest back into the company to dividends paid. Now, using the $50,000 of dividends paid yearly, we can look at how much cash Apple has on hand. If Apple has $300,000 on hand, if business operations halted, they can afford to pay investors for the next 6 years. This would be relatively safe for investors versus if Apple had $100,000 on hand and can only afford to pay for 2 years. Finally, the dividend-paying stock I'm buying right now is FLIC, or the First of Long Island Corporation. This company is in the financial sector and has been consistently paying dividend for the last 26 years. It currently sits just below $19 a share, and their payout ratio based on their current 1-year free cash flow is 37%. They pay their dividend quarterly, and due to the current drop in shares, we can buy this stock well above its 5-year average dividend, which was 3.69%, and now sits at around 4.5%. They have a very stable dividend growth rate as well, doubling from 2016 to our current session, from 13 cents back in 2016 to about 21 cents now. I also just want to say that this is a fairly new channel, and I'm going to be trying to put out videos like this every week. I just put out a video on what stock Warren Buffett is buying and the easiest trading strategy to use in my opinion using SMAs and EMAs. If you can take a moment to subscribe and like the video, it'd be much appreciated. Thank you guys. See you next time.